Welcome back, it's JWalter here. In today's housing market update, I'm going to be sharing some further signs that home buying demand is decreasing. If you follow the channel, I've been reporting this to you guys for the past couple of months here, that home buying demand is decreasing because of sky-high mortgage rates and of course home prices at elevated levels as well. So in today's video, I'm going to be sharing two new reports that was actually just released today at the time of this video, which is the 27th of April. And that is mortgage demand has hit its lowest levels since 2018. In addition to that, pending home sales have also decreased for the fifth consecutive month in the US, according to the National Association of Realtors. So let's go ahead and dive right into this video here. I have a lot to share with you guys regarding this. So I hope you guys get a lot of value of today's video. If you do, then please hit the like button and also consider subscribing as well. I post the latest housing market updates so you can make a more informed decision about whether you should buy or sell a house. So with that said, let's go ahead and dive into the video here. So this is according to the National Association of Realtors. Every single month, they report pending home sales for the entire US. So a pending home sale, again, is when a home seller accepts an offer from a home buyer. That becomes a pending home sale, and then approximately 30 days later, the house closes escrow and the sale is finalized. So this is a leading indicator of our housing market, what's to come in the future here. So anyways, this is actually just released today at the time of this video. They said pending home sales fell for the fifth consecutive month. That's down 1.2% in March compared to February. In addition, compared to the prior year, pending home sales fell for the 10th consecutive month. They fell by 8.2% compared to 1 year ago, as pending sales were down across all major regions in the US. So what this could mean for home buyers out there is that home buying demand is decreasing because mortgage rates have increased approximately 2 percentage points in just this year alone, which is quite astonishing. In addition to that, we're not seeing a decrease in home prices just yet. So home buyers seem to be putting the brakes on purchasing houses right now in greater numbers, or they are simply priced out of this market here. So anyways, let's go back to this report here and I'll share all the details with you guys. So month over month, only the Northeast region saw an increase in contract signings. So every other major region in the US had a decrease in contract signings or pending home sales on a month-to-month basis. And all four major regions in the US reported decreases in year-over-year contract activity. So take a look at this. This is the latest stats we have from the National Association of Realtors. I just pulled this from their website. So they have what's called a pending home sale index. The best way to describe this is that a decrease in their index basically means a decrease in the number of contracts signed for home purchases. So a low amount of the index here means a decrease in contract signings. So right now the index is at 103.7. Again, that's a 1.2% decrease from last month and an 8% decrease compared to 1 year ago. When you look at this figure here, just have a look at how it compares over the past 12 months. We haven't seen levels this low in any single month over the past 12 months. Look at 1 year ago, it was 113. In addition to that, look at the average for 2021. It was 115.2 compared to 103.7. In addition, 2020, it was 111. In 2009, pre-COVID, it was 105.8. So the levels we have right now are far less than we've seen historically speaking here. And this could be a sign that, again, home buying demand is decreasing. On top of this is not just one major region that we're seeing this though, because look at the Northeast. The Northeast is the only region that had an increase in pending home sales, and that increased by 4% compared to the prior month. But every other major region a decrease on a year-over-year basis, and all the other major regions a decrease compared to 1 month ago as well. So Lawrence Yun, who's NAR's chief economist, had a really good quote here that I wanted to share with you guys. So he said the falling contract signings or the decrease in the number of pending home sales are implying that multiple offers will soon dissipate and be replaced by much calmer and normalized market conditions. I would honestly love to see this because it's been a strong seller's market for many years across the United States. So I would love to see home buyers be in more normal market conditions and not in conditions where they have to offer way over asking, waive all their contingencies in order to get their offer accepted, and they're competing against 10 other offers. In any case, he said, as it stands, the sudden large gains in mortgage rates have reduced the pool of eligible home buyers, and that has consequently lowered buying activity. He expects the average 30-year fixed-rate mortgage in the U.S. to reach 5.3% by the fourth quarter, which I'm kind of scratching my head over that because right now mortgage rates are approximately 5.3 to 5.5% at the time of this video, which is April 27th. So anyways, he says mortgage rates are going to be averaging, or his forecast is going to be averaging 4.9% in 2022. And keep in mind, we started the year at around 3.3%. So he's saying on average, it's going to be 4.9% for the entire year. And it's also going to hit 5.4% on average for 2023. We'll have to see about this because mortgage rates are already in this range already, and they are expected to potentially increase further as we go into 2023. He also forecasts inflation to average 8.2% for the entire year of 2022, although it will start to moderate to 5.5% in the second half of this year. Right now, the Fed wants the target for the long-term rate for inflation to be in the range of 2 to 2.5%. So if we're at 5.5%, we're basically still double the percent that the Fed wants the inflation to be at. And that, of course, causes the Fed to further increase the federal funds rate to combat inflation. So in regards to the total number of home sales in 2022, Yoon went on to say the following. Overall, existing home sales this year look to be down 9% from last year. Home prices are in no danger of a decline on a nationwide basis, but the price gains will steadily decelerate, which means home prices are still increasing, but not increasing at the same rate as compared to last year, such that the median home price in 2022 will likely be up 8% from last year. I don't really necessarily agree with this so much. I don't think there's absolutely no danger of a home price decline. However, I really don't see a housing crash happening anytime soon because we have a lack of houses for sale. In my personal opinion, we can't have a housing crash if we have record low housing inventory across the United States. That's just my personal opinion. But I don't see any big declines in home prices anytime soon because of that. But I wouldn't say there's no danger of a decline. I think that's a little bit far-fetched. We'll have to see how this year transpires based on mortgage rates and, of course, home buying demand as well. And, of course, if more people list their houses for sale and inventory increases greatly, that, of course, could impact prices as well. However, I don't really see a big increase this year for existing owners selling their houses just because rates are so much higher than people have current rates right now. Most people, or a lot of people, I would say, let me repeat that. Millions of people have rates of less than 3%. So why would they move to a 5.5% mortgage rate when they have a 3% current rate right now? In any case, we'll have to see how it transpires. I am not a real estate market fortune teller. He also says fast rising rents led to a boom in multifamily housing starts. So basically, fast rising rents are encouraging people to buy houses right now, but they're facing headwinds because there's a lack of houses for sale. And of course, we have very high mortgage rates compared to 1 year ago. So compared to 1 year ago, mortgage rates were approximately 3%. Now they're at about around 5.5%. So in regards to what he says here, we have a boom in multifamily housing starts because builders are more bullish regarding the rental market. I want to share the latest stats with you guys. I know I went over this in my previous videos, but I want to share this very, very briefly with you guys in case you guys missed it. So here's according to the U.S. Census Bureau. They actually just announced this about a week ago. These are housing starts. So overall in the U.S., housing starts are increased by 3.9%, but that's because we have a big increase in the number of multifamily properties that are being built right now for apartment buildings for rent. So these 5 units or more, if you actually look at the data itself here, I actually looked at it myself, about 91% of all these houses here, or all these multifamily units here, 5 units or more, are really 25 units or more, basically apartment buildings, and the purpose of construction is for renting. This is not for building condos to sell. So the vast majority of these are for apartment complexes to rent out. So as you can see here, housing starts increased 28.1% compared to 1 year ago. However, in stark contrast, housing starts for single family houses have decreased by 4.5% or 4.4%. So right now we're seeing a big increase in the number of multifamily housing starts and also multifamily permits pulled as well. So right now builders are more bullish regarding the rental market and not single family houses, which are tied more directly to mortgage rates than multifamily. And they basically summarize this here. They said with rising mortgage rates, Yoon added that single-family home builders will be more cautious, as you saw there in the stats there with the latest update we have from the U.S. Census Bureau. And by the way, the National Association of Realtors Pending Home Sale Index is a leading indicator for the housing sector based on pending sales of existing houses. Again, that's when a home seller accepts an offer from a home buyer. A sale is listed as pending when the contract has been signed, but the transaction has not yet closed, though the sale usually is finalized within 1 or 2 months of signing. So in California, I would say on average, our approximate time frame when a contract is signed to when it closes escrow or the sale is finalized is approximately 25 days to 30 days. Okay, that's the first report that I wanted to share with you guys. That's basically a forward-looking indicator of where our housing market is headed here. In my opinion, we're starting to see a lot of factors right now that's clearly showing that home buying demand is decreasing because of rising mortgage rates here. So the other report I want to share with you guys today, which was also released today with the 27th of April, was according to the Mortgage Bankers Association, or the MBA. So every single week I report, and they also report the number of mortgage applications for people submitting loan apps for refis and also for purchases. I'm more focused on purchases because that's really an indication about what's going on with our housing market, whereas refis are more tied directly to mortgage rates than anything else. So in any case, let me share this with you because the share of people submitting loan applications for home purchases has been decreasing greatly. And I've been reporting that to you guys here on a weekly basis here as well. But first, let's talk about refis. Refis have decreased 71% compared to 1 year ago. Again, that makes sense because we have mortgage rates increasing greatly, and therefore a lot less people are doing refis. However, look at their purchase index. That decreased 7% compared to 1 week ago and has decreased 17% compared to the same week 1 year ago. So it decreased compared to 1 week ago and also decreased compared to 1 year ago. But let's have a look at a more long-term trend here. And this is according to the Mortgage News Daily. They actually pull this information from the Mortgage Bankers Association. So this orange line here is the average 30-year fixed rate mortgage. So we are more or less at all-time record lows back in August of last year. Also in January, it was a little bit lower than that. But in any case, it was very, very low in the early parts of August of last year when mortgage rates were approximately 2.77%. Now they are approximately they're more than that. They're 5.28% at the time of this video. In any case, here's what I want to show you guys. So have a look at this. So all-time record lows were set, let's just say August 2nd of last year. And this blue line here, this shaded line here, is their purchase index. So again, when the purchase index increases, we're starting to see more contracts signed by home buyers and home sellers, I should say too. But have a look at this. Ever since the early parts of August, have a look at the purchase index, which has increased more or less ever since the all-time record lows in August, and basically ever since January 31st. So January 31st was basically an inflection point where the amount of purchase activity or the amount of home buyers submitting applications for home purchases has been declining. As you can see here, the purchase index has been on a declining trend really ever since then. And when we look at what happened with mortgage rates during this time, look at what happened in mortgage rates. So at this time, January 31st, the average rate was at 3.55% and absolutely skyrocketed ever since then. And that caused the number of applications for home purchases to decrease as well. It makes sense that based on January 31st, if rates were at 3.55% and now they're over 5%, it makes sense that we're starting to see this decrease in the number of applications. And Joel Kahn, who's the MBA's Associate Vice President of Economic and Industry Forecasting, stated the following. With mortgage rates increasing last week to the highest level since 2009, applications continue to decline. Overall application activity, that includes refis and purchases, fell to the lowest levels since 2018, with both purchase and refis declining. The drop in purchase applications was evident across all loan types, meaning conventional loans, FHA, VA, etc. So the drop in purchase applications was evident across all loan types. Prospective homebuyers have pulled back this spring as they continue to face limited options of houses for sale, along with the higher costs from increasing mortgage rates and prices. The recent decrease in purchase applications is an indication of potential weakness in home sales in the coming months. So there's a couple things I want to bring to your attention in regards to this quote here. So in regards to this pullback this spring, this is pretty unusual during this time of year. So during this time of year, which is again the spring months, of course, we tend to see a lot more home buyers submitting loan applications, and also we're trying to see a lot more activity from home buyers. But right now we're seeing just the opposite. So rather than having an uptick in our housing market right now, which is what we typically see, we're actually seeing it pull back. And this is a clear sign to me that I agree with them. This is a potential weakness in home sales in the coming months because home buying demand is decreasing. In regards to higher costs from increasing mortgage rates and prices, let me give you a brief example. So right now, mortgage rates are approximately 5.3%, let's say. 1 year ago, they were approximately 3%. If you were to get a house at $500,000, putting 20% down, and your loan amount is going to be $400,000, if you compare 1 year ago to now, your mortgage payment, just based on principal and interest payments only, would be an increase of $555 more per month, just because mortgage rates have increased over 2 percentage points in the matter of 1 year. And therefore, because of this is putting a lot of home buyers on the sidelines because of affordability challenges. Here's another alarming trend that I also want to bring to your attention. And I've been reporting this to you guys over the past several weeks here, or several months really. But we're starting to see more and more home buyers using adjustable rate mortgages to buy houses rather than 30-year fixed rate mortgages. So according to the Mortgage Bankers Association here, they said in a period of high home price growth and rapidly increasing mortgage rates, borrowers continue to mitigate higher monthly payments by applying for adjustable rate mortgages, which tend to have a lower mortgage rate compared to a 30-year fixed rate mortgage. I'm going to be sharing some example with you guys here in just a little bit. The ARM share, or the adjustable rate mortgage share of applications last week, was over 9% by loan count and 17% based on dollar volume. So we're starting to see a big increase, and that increase in the share of people submitting loan applications for adjustable rate mortgages has basically doubled in the past 3 months. So basically 3 months ago, the share was, I believe it was around 3.5%. Now it's at 9%. So a big increase in a very short period of time. Let me give you an example about why people are doing this right now. So this is according to the Mortgage News Daily to give you an example regarding this. So right now, the 30-year fixed rate mortgage, the average across the United States for people with exceptional credit is 5.28%. However, the mortgage rate right now for a 5/1 ARM, which basically means that your mortgage payment is fixed for 5 years and then it becomes variable after that. In other words, after that 5-year term, it adjusts to current market conditions. In other words, if mortgage rates continue to increase, so will your mortgage rate and also your housing payment. So the rate on a 5/1 ARM is at 4.2% versus 5.28% for a 30-year fixed rate mortgage. So if you were to get a loan for $400,000, let's say you buy a house for $500,000, putting 20% down, a loan amount of $400,000, your principal and interest payment for a 30-year would be just over $2,200 per month. However, for a 5/1 ARM, it would actually be less than $2,000 per month. So in other words, a monthly savings of over $200 per month. So if people are getting priced out of this housing market and they're seeing that, hey, I can't afford $2,200 for a 30-year fixed rate mortgage, but I can't afford a $2,000 a month payment for a 5/1 ARM, I'm just going to be using an adjustable rate mortgage and I'm just going to be refinancing after that 5-year period. The big risk there, in my opinion, though, is that what if your house is underwater? If your house is underwater and you have negative equity, I'm not saying that home prices are going to be decreasing, but they could. But if you have negative equity in your house, you're not going to be able to refi. And on top of that, if mortgage rates continue to increase greatly, let's just say right now it's 4.2%, but in 5 years, what if it's 8% or 7%? Then your housing payment is going to be increasing greatly. So this could potentially cause a financial hardship for homeowners who can no longer afford their housing payment if their housing payment increases greatly. In contrast, though, if mortgage rates subside and they don't increase much further than we have right now, and if home prices also increase, then this could potentially be a good loan product for those looking to buy a house right now. However, in my personal opinion, this loan product is very risky because mortgage rates are anticipated to increase further. And of course, there's no guarantees what home prices are going to be like when the rate becomes a variable. So again, you can get a 5/1 ARM, a 7/1 ARM, or a 10/1 ARM. Obviously, the longer the fixed rate period, the less risk it is. However, I would much rather see people use 30-year fixed rate mortgages because your mortgage rate is fixed for 30 years and therefore your housing payment more or less is fixed for 30 years as well, excluding, of course, increases in property taxes and insurance. So comment below with your biggest takeaways from today's video. Also, if you want a real estate agent referral in your neck of the woods, check out that link below. Hope you got a lot of value out of today's video. If you did, please hit the like button. I greatly appreciate that. And also consider subscribing if you haven't done so already. Hope you have an awesome day and look forward to seeing you on the next video.